Finally, we are starting to see a global shift in the borrowing cost. Interest rates are finally starting to pivot downward, and in markets everywhere, that fear of missing out is starting to creep back in. But before you jump into this new cycle, I need to give you a serious warning. In 2026, a lower interest rate is often the ultimate smokescreen. It makes bad properties look like good deals just because the monthly payment is finally moving in the right direction. But real estate is no longer a rising tide that lifts all boats. We are in a split economy. While certain innovation hubs are surging, other property types are becoming, zombie assets that will bleed your bank account dry. Now, I want to be clear here, okay? I'm not saying you should never buy these properties. Real estate is personal, and the right home for one person is a nightmare for another. But what I'm saying is that in the 2026 market, these 5 specific property types carry hidden risk that most buyers aren't seeing. I'm Mac Rogers. After decades in the business, I've seen that a good deal on a purchase price can quickly turn into a money pit if you don't understand the reality of the new economy. Today, I'm breaking down 5 property types I would think twice before buying unless you are fully prepared for what comes next. Let's look at the first one, the legacy urban condo. When I say legacy, I'm talking about high-rise buildings in major city centers that are 20, 30, or 40 years old or more. These buildings were designed for a 5-day work week. That culture is officially gone. So what does that mean? It means these units were built as, crash pads. They have tiny galley kitchens that were not meant for daily cooking and no flex space for a home office or a Zoom call. In 2026, buyers aren't just looking for a place to sleep. They are looking for a place to live, and these older floor plans are becoming obsolete. But the real trap here is the special assessment. This is a global crisis. As these buildings age, they are hitting a financial brick wall. In Florida right now, new safety laws are hitting homeowners with bills as high as $90,000 per unit just to modernize elevators and structural foundations. In London and across Europe, strict new green energy mandates are forcing owners to pay tens of thousands to retrofit old heating systems and cladding. When you buy into an older high-rise in 2026, you aren't just buying a home. You are inheriting a share of a massive aging machine. You might get a great deal on the purchase price, but you're taking on what I call a hidden mortgage. One day you're fine, and the next day the HOA board drops a $50,000 bill on your doorstep for repairs. If you are looking at a building over 20 years old, you better spend more time reading the reserve study than looking at the view. Number 2 is one catching people off guard globally. Older suburban homes that haven't been climate hardened. In 2026, the old saying, location, 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 has been replaced by insurability, insurability, insurability. Interest rates are down, so the charming fixer-upper, it looks attractive again. But before you fall in love with that 1970s character, you need to check the insurance quote. We are seeing a global retreat by insurance carriers. In California, major companies have stopped writing new policies entirely. In Australia, 1 in 25 homes is predicted to be uninsurable by the end of the decade. In the UK and France, premiums are hitting record highs to cover flood and wind damage. If a house has an outdated roof, old electrical system, or is located in a designated flood or fire zone, you might find it impossible to get a standard policy. You'll be forced into a plan of last resort, where the premium can be higher than your property tax. In this market, the cost of carrying a home is more important than the purchase price. If a house is uninsurable, it's a zombie asset. You can't protect it, and eventually you won't be able to sell it. In 2026, if you haven't checked the insurability before you sign that contract, you're not being real. Number 3, pseudo-luxury properties. During the building frenzy of the last few years, a lot of developers rushed to build homes that they label as luxury just to justify those high 2026 price tags. But there is a massive difference between a luxury home and a house with, fancy light fixtures. I call these commodity mansions. They look great, in drone shots, but the second you step inside, the shortcuts are everywhere. In a cooling economy, these are the first properties to see massive price cuts because they aren't unique. They are interchangeable. When you walk through a new build today, perform the savvy quality test. Knock on the interior doors. Are they solid wood? or are they hollow core plastics? Open the kitchen drawers. Are they high quality plywood or cheap particle board? If a builder used builder grade materials on the things you can touch, imagine what they did with the plumbing, the insulation, and the framing, the ones that you can't see. In 2026, true quality holds its value, but pseudo-luxury is a trap. If you're paying a premium price, make sure you're getting premium build, not just a house that was built for an Instagram photo. Number 4 is the one hitting investors hardest globally right now. Properties bought strictly for vacation rentals like Airbnb. In 2026, the wild, wild west of short-term rentals is over. We are seeing a global regulatory hammer coming down. Just look at what happened in the heart of the US economy. When New York City passed Local Law 18, it didn't just regulate the market, it effectively wiped out the entire short-term rental business model overnight. Think about that. Thousands of investors who bought condos in New York City counting on vacation rental income were suddenly stuck with properties they couldn't rent to tourists. And if you think this is just an American phenomenon, you have to look at Europe. In Barcelona, one of the most visited cities on earth, the government has taken the nuclear option. They aren't just taxing rentals anymore, they are ending them entirely. When a city like Barcelona decides that every single tourist license has an expiration date, it sends a massive shockwave through the global market. I call this the Airbnb hangover. If your plan to pay the mortgage relies on tourists staying there 20 nights a month, you are in a high-risk zone. Before you buy an investment property in 2026, you have to perform the LTR test. Ask yourself, if I am forced to turn this into a long-term rental, does the rent cover the mortgage? If the answer is no, you aren't buying an investment, you're buying a gamble. Finally, number 5 is a property type that looks like the perfect solution to 2026 prices, but it's actually a global wealth trap. Any manufactured home or prefab home where you do not own the land. With traditional home prices hitting record highs, land lease communities are exploding in popularity. In the US, we call them mobile home parks. In the UK, they are park homes. And in Australia, they are residential parks. They are marketed as a way to own a modern home for a fraction of the price. But here's the reality check most buyers miss. When you buy the house but rent the dirt, you are putting your capital into a depreciating asset while someone else owns the appreciating one. In 2026, we are seeing a massive shift where large institutional investors and private equity firms are buying up these parks globally because it costs tens of thousands of dollars to move these structures, and for many older units, it's physically impossible. You are essentially a financial hostage. I'm seeing ground rents and site fees skyrocketing in the UK and Australia, eating up the residents' equity faster than the house can appreciate. In this cooling economy, the most valuable part of real estate is the scarcity of land. If you don't own the dirt, you aren't building a legacy. You're just a tenant in an inexpensive box. Real estate in 2026 isn't about being afraid to buy. It's about being informed. Every property we discussed today could be the right home for someone, but only if you go in with your eyes wide open, to the long-term math and the global shifts we are seeing. Now, this was the cautionary side of the market, but it's not all bad news. There are specific property types right now that are actually thriving in this split economy. The ones that are building equity while others are stalling. I'm currently putting a deep dive into those market winners, so if you want to know where the smart money is actually going next year or this year, make sure to subscribe and hit that notification bell so you don't miss it when it drops. If you're in the San Francisco Bay Area, my team and I work directly with clients to navigate these exact issues. But even if you're outside of California, anywhere in the US, please don't try to navigate this complex market alone. I've spent years building a network of highly reputable, savvy agents across the country. If you need a professional in your corner who sees the market the way I do, reach out to me using the contact info in the description below. I'll personally put you in touch with a top-tier agent in your specific area to make sure your next move is a smart one. Until next time, stay savvy. I'm Mac Rogers, and I'll see you on the next one.